Hello everyone. I am Patricia Lenya. Today, we present the Chapter 3. Before that, this is the list name of my group mate. So, today, I will explain the term of revenue and expenses in the cash and accrual accounting. Let's get started. What is revenue? Generally, revenue can be defined as the value of products and services produced by a business during an accounting period. Revenue can either in cash or in non-cash. In cash accounting, revenue is recorded when and only cash is received for a sale of product or service. For example, Sarah purchased the pens from Company A in February, but she paid it in March to Company A. So, Company A will record this revenue in March as they received the payment in March. Meanwhile, in accrual accounting, revenue is recorded when the item is produced, regardless of when sold. For example, Adam purchased tuxedo from his supplier, ShopX, and he paid using check at the next month. However, this still recorded in the book account of ShopX as the revenue even though Adam purchased tuxedo without any payment, because accrual revenue is the revenue that earned by providing good or service, but for which no cash has been received. What about expenses? Expenses can be defined as a cost or expenditure incurred in the production of revenue. Accrued expenses is an accounting term where the expenses is recognized on the books before it has been paid or incurred. Meanwhile, cash expenses is term in cash accounting where the recognition of expenses when they are paid in cash. What about the impact of debtor and creditor to the business? So, creditor and debtor is in accrual accounting, where accrual accounting is an accounting method where revenue or expenses are recorded when a transaction occurs, rather than when payment is received or made. For example, Sarah borrowed money from Lena. Therefore, Sarah is debtor, Lena is creditor. As the creditor, Lena can gain profit through the interest of loan that she charged on Sarah, but when Sarah cannot pay the debt, she will facing the loss. Meanwhile, as a debtor, Sarah need to pay the money she borrowed with the interest of loan that Lena has charged her.
Basic of cash accounting. What is cash accounting? Cash accounting can be called as cash basis accounting. In cash accounting, when a cash is received, it will be recognized as revenue, while when a cash is paid, it will recognized as expenses. Cash accounting is simple, straightforward, and mostly used by smaller companies than large companies. It is contrast with accrual accounting in the terms of timing, recording, and transaction. 1. Time, when the revenue and expenses is recognized. Revenue, recognized when cash is received, expenses, recognized when cash is paid. 2. Recording, only recorded when the exchange of money occurs. 3. Transaction, straightforward by using cash. Does not involve account payable and account receivable. Cash accounting does not give any impact to the account payable and account receivable. As for the effect on the cash flows for the revenue and expenses, let's look and study the given question. How much is the profit that Lily will get by using cash basis method? Here is the solution. For the cash accounting method, the key is to focus on the amount received and paid only. Ignore the other amount earned and billed. However, cash accounting doesn't work as well for larger companies or companies with a large inventory, because it is difficult to know the real picture of the liabilities that already incurred, and it might obscure the true financial position. Hello, I'm Angeline Liliana. Advantages and disadvantages of cash accounting. Advantages of cash accounting. First, it is simple and easy to understand. It is much easier to learn and implement. don't need for trained accountant and accounting software. This cash accounting does not need to follow different methods or rules of account. Keeps track of cash accurately, where we can keep in control on our cash. Disadvantages of cash accounting. Fails to reflect correct profit or loss, there can be immense fluctuation in result. Fails to reflect correct financial position of a business or company. It does not recognize outstanding payments or revenues to be received. Not all businesses can use cash accounting. You cannot use it if you sell products or services on credit. 3 important things in determining cash accounting. The transaction must be recorded at fair market cash value on what has sold or received. A company cannot delay recognition of income. It must be recognized when it is received. About outputs of accounting cycle. Definition of output. Output is the amount of goods or services produced within a period. This measure can apply to an individual, a working unit, or an entire entity. The amount of output can be compared to units of input, such as hours worked, to determine a level of efficiency. 3 major outputs in the accounting cycle. 1. Income statement. 2. Balance sheet. 3. Statement of retained earnings. That current period that is being entered the journal. To find the information for the income statement, you will use the adjusted trial balance. Process of accounting system. 1. Pick a reporting period. 2. Generate a trial balance report. 3. Calculate your revenue. 4. Determine cost of goods sold. 5. Calculate the gross margin. 6. Include operating expenses. 7. Calculate your income. 9. Calculate net income. 10. Finalize the income statement. 2. Retained earnings. This statement shows how much a company chooses to keep then distribute among the shareholders. Definition of retained earnings. RE. The amount of net income left over for the business after it has paid out dividends to its shareholders. Retained earnings formula and calculation. RE equals BP plus net income, or loss, minus C minus S. Where BP equals beginning period RE. C equals cash dividends. S equals stock dividends. 3. Balance sheet. Capture assets, liabilities, and stockholders' equity. This does not have the overall detail of line by line, but captures the whole account period. By following the step of the account cycle, you are capturing all expenses, assets, liabilities, revenue, among many more things. Definition of balance sheet. A financial statement that communicates the so-called book value of an organization, as calculated by subtracting all of the company's liabilities and shareholder equity from its total assets. Process of preparing balance sheet. 1. Determine the reporting date and period. 2. Identify your assets. 3. Identify your liabilities. 4. Calculate shareholders' equity. 5. Add total liabilities to total shareholders' equity and compare to assets.